So now, what is Forex imbalance? What are imbalance? What are psychological levels? How can we make money from them? How do we understand them, and how we can, take advantage of them to put money in our hands? As the topic implies, from chaos what to clarity, how to profit from the Forex imbalance and psychological key levels. Now let's look at the objective of today's study. The objective of today's study is to help you as a trader understand Forex imbalance, psychological zones, and how you can combine these two concepts, right? To, pretty much make your charts to be much more simpler. You can now use these concepts, Forex imbalance, psychological levels, to marry the both of them together and know where the price of this asset is truly heading. That is the objective of this study. Let's look at what Forex imbalance is. What is Forex imbalance? And I'm going to explain it, from what I've written here. I'm also going to explain it in a layman terms. Okay. Now, if we look at the price of a particular asset, usually when you take a trade, your trade goes through, a process from the broker, then it goes to the liquidity provider. This liquidity provider matches your buy trade with the sell trade. Okay. So we have BIS, Bank of International Settlement. All of these guys are liquidity providers. So let's say you press a buy, for example, and it goes through. What is happening is that in split seconds, your buy trade has been matched to a sell trade. So in order for you to buy something successfully, somebody must be willing to sell from the other end successfully as well. If there is no seller on the other end, that trade cannot go through. It will oftentimes be rejected because there is no corresponding sell order to match that buy order. So in an efficient market, what happens is that we have a buyer, we have a seller, they come together to agree at a certain price, and that transaction happens. We call it a successful transaction. So Forex imbalance, also known as what? Is also known as inefficiency or price inefficiency. It usually occurs when there is a significant disparity between what? Buying and selling orders. So let's assume we want to buy, let's say, 20 units of Euro USD, for example. That would mean there must be 20 units of sell orders on the other side of the trade for that transaction to go through. Well, let's say we have just 20 units of, sell orders that are available. And then we have an institutional bulk, level of buying. Let's say we have an institutional level or an institutional order. Let me put it that way. We have an institutional order for 100 units. Remember, we have just 20 units that is available. Okay. And now we have 100 units. Simple economics. When demand is higher than supply, what will happen? Prices will tend to what? Go up. So as long as demand is higher than supply, by the time they take the 20 from the 100 we have to buy and match it with the 20, right? We still have about 80 units to be pumped into the market. By the time we dump that buy order on the market, it tends to give you something like a gap, like an imbalance that we'll be looking out for. Okay? That imbalance is a gap that price has to come back and fill. For example, this is a clear example of what we're talking about. We have an efficient market here, closing price, touching opening price touching closing price. We have pretty much an efficient market here. But when it came down to this side, you see something like a huge drop in price. That would mean that the amount of sell orders has completely obliterated the amount of buy orders in the market, thus making the price of this asset to crash to the downside. I repeat, when we have a lot of sell orders, institutional sell orders coming into the market, and it is swallowing up the buy orders, what you tend to see is a sharp decline in price. Pretty much you see that gap. That gap is what we call a fair value gap or an imbalance, because an efficient market is supposed to function in a way that buying orders will be married to sell orders. But when you see a gap like this, that would mean that there is a lot of sell orders, unfinished transactions. I repeat, unfinished transaction that has caused this gap in price. And that would mean price must have to go back to that unfinished zone to complete those zones, clear out those levels, cover those gaps, right? And then move in the direction that it was actually designed to move. So this imbalance what leads to what? Rapid price movement as the dominant force, either buyers or sellers, absorb the opposing orders. So now let's look at it now. Let's look at a fair, a fair play, like a balanced market. All right, an efficient market. An efficient market is, a buy order matching a sell order. And clearly, if you look at the way the price is, trading, there is pretty much no imbalance here. You can see that where the price closes here, right, price opens and then goes up, right, and then look at this one. It comes back there to then what? Kiss out the levels that what? Price has initially created, and then that just keeps on going. Even this place that there was supposed to be an imbalance, price came back and filled that price. It came back and what? Filled that level. So you can see once there is a price gap, price needs to come back to that same level that gap was created, right? Fill those gaps, because there are a lot of unfinished transactions right here that are sitting here that price needs to come back and close. And then when price comes back close there, you can see what happens. Price will still go in the direction that it was designed to go. Same thing here, just like that. Price created some kind of an imbalance at this point right here. And then you can see what happened. Price came back to close that imbalance because there is something like an unfinished transaction that is happening right here. Price came back, closed it, and then came to the downside. So it is safe to say that anytime you see an imbalance, it doesn't matter how long it will take, but definitely price is going to go back to imbalance zones, fair value gap zones, to complete out those transactions. It's a known fact, because that is how the banks, that's how their books will be settled. If those price gaps has not been filled, their books will not be settled. They will have some pending transaction happening. So that for us is a blueprint to how we can trade imbalance, because we know that, okay, definitely price is still going to come back here anyways. We don't know when it's going to happen now. It's going to happen next week. It can even take 1 year to happen, right? But definitely one day we know that price is going to come there. And we know that that is an opportunity for a trade setup, okay? Now let's look at, liquidity. I've explained this, again and again, but I still need to explain it because we have some newbies in the house. So I had to bring out this, sweet shop, this lollipop sweet shop. Let's assume that everybody wants to buy lollipop, okay? We have lots of people that wants to buy lollipop, People are buying, people are selling, people are buying, people are selling. Then suddenly something happens. Lots of people suddenly want to buy all of the lollipops in the market. All right? Maybe there is a super delicious flavor, or maybe there is just not few in the market and people wants to buy it. What will happen? The price of the lollipop will go up. So once demand exceeds supply, what happens? The price of that asset continues to go up. So it's safe to say that anytime you see that price is gapping up, demand has somehow exceeded supply here. Demand has what? Exceeded supply here, and then what? Price is what? Gapping up. Whenever price wants to come down, that would mean supply has what? Exceeded what? Demand. The sellers in the market are way bigger, way more than the buyers in the market. So that would make price to come even further down. All right. That is how the market actually operates. Now, what are the causes of this imbalance? What are the causes? What causes price to have imbalance? What causes price to have, fair value gaps? What causes price to have this unfinished transaction? There are certain factors, there are several factors that can create imbalance in the Forex market. Number one, large institutional orders. I repeat, large institutional orders. And these orders can be placed by banks, central banks, hedge funds, and other large institutions, all right, that execute their orders on a massive scale. These guys can cause a significant push in the price of market. Let's assume that retail traders are currently buying, right? And then the market makers are looking at the possibility of selling, so everybody's stop loss will be taken out, because you know this market is a movement of liquidity to liquidity. There is a liquidity sitting somewhere, liquidity that is stop loss. The banks may not know where you have placed your trade, but they know where your stop loss might be. So when they see those levels, right, they know that, okay, retail traders must have placed a sea of stop loss around there. Let's go and take those liquidity out and then crash price to the original direction. Which is why you can be in a trade that is supposed to go down. You have seen everything that the price is going down and you place your sell. But because you don't understand the concept of imbalance and psychological levels, most times your trade will be taken out in stop loss and it will still go in your direction. The trade has kicked you out, but yet you got the direction right. So what is the problem? It's because you don't know where these institutional orders are. And these institutional orders, they are not hard to spot. Wherever you see a price gap, a fair value gap, an imbalance, just know that that is an institutional footprint. Any place you see in the market that you see a price gap, that, my friend, is an institutional footprint. So part of the causes of imbalance is the interplay of interest among institutional orders. Hedge funds are not excluded. Big banks are not excluded. All these large financial institutions, they often would execute massive orders that can overwhelm all the orders of the retail traders. Another cause of imbalance is news event and economic data release. If you've been trading the market for a while, you would know that news events can alter completely the cause of a particular asset. Euro USD can be going down, peacefully going down, and then NFP happens. Or Fed Chair Powell speaks, he gives a speech, or Donald Trump wants to give a speech. And by the time he is done with his speech, Euro USD that was going down, that you can see that this pair is going down to hit a psychological level, or is going down to clear liquidity. Suddenly, after that news event, after that economic data release, what happens? Euro USD just change direction and start going up. So this high impact news can what? It can trigger a sudden influx of buy or sell orders, because traders react to what? New information. So before the news is out, your competitors in JP Morgan, they are watching their charts. They're already plotting their graph on where to go, which direction to go. Where are we pushing the price to? As I tell you, it's a game of liquidity. So other blocks, it brings us to other blocks now, because all of these are causes of what? Imbalance. Another cause of imbalance is what? Other blocks. Another block is what? A secret spot on the trading charts where the big traders, like the big banks, must have placed their orders. Their smaller hidden buy or sell orders. It is a place where they have shown a lot of interest in either buying or selling. When the price of money comes back to this secret spot, it often what? Reacts, because these hidden orders are still there waiting to be filled. So we have a lot of orders that are waiting to be filled. And that has made price to gap, thus creating what? An order block that needs to be filled, that needs to be mitigated. So price must always, when price gets back to that order block, what happens? A reaction is expected. And if you understand how the reaction works, you can make so much money from this market. I'm talking with the perspective of a long-term trader and also a scalper, because all of these things happen. A typical example is what we have here. Price crashed down. You can see the institutional activity. You can see the gaps. That is to tell you that there are institutions that have interest here. And then we spot the other block. One of the easiest way to spot an order block, right, is to check, if you are looking for a downtrend, is to check the last place the banks bought before the price crashed to the downside. I can find my order block right here, the last place they bought before they crashed the price to the downside. And guess what has happened? Because there are a lot of secret orders that are inside of this place, it will cause price, right? because we have a lot of things here that needs to be offloaded, right? They are still going to push the price back into that other block, and guess what happened? Price begins to crash to the downside. Price goes to the other block, it crashes to the downside. If I'm making sense, type value in the comment section. If I'm making sense, type value in the comment section. Let's go. So how can we trade with imbalance? How do we use the concept of imbalance to make money? How? I've written down some steps that we can use to, make money with imbalance. Now, the core idea is that the market tends to revisit this area of imbalance to fill the inefficiency. So now this already provides a trading opportunity for us. So how do you spot it? Look for reversals at unfilled imbalances. You can look for reversals at those places that there are imbalance, such that when price gets to that point, price begins to reverse, and you are part of that reversal. So when price returns to an area of significant imbalance that hasn't been fully mitigated, it can act as a support or a resistance, which can lead to a reversal, a complete reversal in price. Example of that is what I find here. Price rallied up to this point. Usually everybody will be saying, okay, this is my resistance, this is my resistance. But see, price did not get to the resistance. That is to tell you that this imbalance, when price has filled this imbalance can now serve as a dynamic resistance. So you can see price came into the imbalance, crashed to the downside, which would be a clue for you. A clue for you, because you are waiting for reversal. And once you see a potential reversal within this imbalance, a very strong reversal for that matter, what happens? You want to begin to target that same point, because you know that if price comes back into that same level, price is going to crash to the downside. So that side is serving as a resistance, a strong resistance for you. Another way we can trade imbalance is to trade in the direction of the imbalance. After a strong impulsive move indicating imbalance, anticipate a continuation in that direction, especially if it is supported by other confluences. We are going to go into the charts just quickly, so I'm going to show you how to understand all of these things. Are we together? So now, that's for imbalance. Let's look at the charts, for example. This is gold on a 4-hour time frame. Can we spot some imbalances? I can see one quickly here. How do you spot an imbalance? Let me expand it for you. There's an indicator that I like to use. If you apply that indicator on your chart, it is going to just automatically give you the imbalance. But before I do that, let me first of all show you raw how to spot your imbalance very, very easily. Take into consideration 3 candlesticks. Is there a gap in the middle candlestick? So we have 1, 2, and 3 candlesticks. If I zoom it in, right? These are the 3 candlesticks we are considering. If you look at this market now, there is nothing here. There is no imbalance here. Everything was completely covered. But when it got here, look at the lowest point that price has made. This is the lowest. Let me use a trend line. This is the lowest point that price has made for that candlestick. Okay? This is the lowest of this candlestick. And then price closed below it. And then for this other candlestick, the price came, and then this is the highest. Clearly, you can see that for this market to be efficient, we needed price to at least, tap and close up that gap. But you can see that clearly, this is the highest that this candlestick has made. So we have a price inefficiency here. We have a price inefficiency here. 1, 2, 3 candlestick, lowest, highest. There's this gap here. For this market to be efficient, price needs to at least, even if it is the week, you should at least touch this point right here for this market to be efficient. But you can see that we have that much space that needs to be filled in the market. So already you have your clue. You can say, okay, well, I can see this price gap right here. That would mean price, well, I'm expecting that somehow price is going to come back to this zone. Yes, I know that it is selling, but when price comes back into this zone, that is when I want to consider my trade. And then if we draw this line outside, if we draw this line out on a straight line, can you see it? This gap right here, what happened? Price came back, filled that gap, and then started crashing to the downside. This trade can put $200 in your hands at 0.01. This trade right here, from here to here, can put at least $200 in your hands at 0.01. So when you see this kind of reversal like this sharp drop, and you see a big imbalance, especially on a 4-hour candlestick, you don't want to joke with that level. Are we together? Are we together? Good. So that is about what? Trading in the direction. So now let's look at psychological levels. Psychological levels. Psychological levels, they are key zones. Everybody type in the comment section, key zones, key zones, key zones, key zones, key zones. They are what? Key zones or whole numbers that a lot of business transaction happens around. Key zones, and I'm going to teach you how to draw psychological level, because the purpose of this lecture is to marry imbalance as well as psychological levels, how you can use the both of them. Because if you are selling, for example, let's say you are selling gold, for example, are you supposed to just be selling blindly? At least you should know the psychological level where gold is going to react from. At least you should have a perspective of, okay, if I'm selling from here, where should I be selling to? Where should I be taking my profit? Because one of the worst things that can happen to you as a trader is that a trade crashes down into profit, you did not close, and then the trade started reversing against you, thereby taking away part of the profit that it has given to you. Psychological zones. These are levels often end in what? Round numbers. 1.2000, 1.5050, 100. These are what? Round numbers. They are what? Levels that traders often place their entry orders, take profit level, stop loss orders all around this zone. And we're going to check how we can, get these psychological levels in place. We have different types of psychological levels: big round number psychological levels, half number psychological levels, quarter number psychological levels. For me, I like the big number psychological level. It doesn't in any way take away the place of the half numbers and quarterly numbers. I like the big number psychological level, and I'm going to show you how to plot it and how you can, basically get into it. Why are psychological zones very, very important? Most people will be asking, why are these levels very, very important? Why should I care as a trader? Why should I care as a trader? Now, the reason why you should care as a trader is because people tend to gravitate towards these psychological levels. Why? Because they are easy numbers to remember. And the Forex market is not in any way different from any other market. People tend to gravitate towards it. Example, you want to buy fuel, for example. Or let's say you want to buy something in the market, and you see something for 5,000, then you see something for 5,100 naira. You would tend to gravitate towards that 5,000 naira price mark. That is how psychological level operates. Okay, so now I'm going to teach you practical how to draw this psychological level. This is an example of huge psychological level, like huge whole number psychological levels. You can see this is the USD CHF, pair, and you can see all of these psychological levels that are gladly respected. You can see the psychological level 1.000. How many times did price touch it? Look at it. Whenever price touched the psychological level, what happened? Price reacted. It touched it, it reacted. It touched it, it reacted. It touched it, it reacted. What does that tell you? There is something about this level that traders respect. There is something about this level that traders care. That is why price, whenever it tries to break it, even when it broke it, it still crashed back down. It still crashed back down. So this, my friend, if you are on a buy trade, for example, and you are seeing this kind of thing happening, on a normal day, if you did not plot the psychological levels, price will just be around there. You say, oh, price is ranging. But because you now understand what psychological levels are, if you're on a buy trade, after your imbalance must have been taken out, and then you join a buy trade, what do? You want to take your profit at these psychological levels, because especially when you see that the psychological level has been respected multiple times. You don't want to be more comfortable when your trade, you entered somewhere here and your trade is here and you are seeing all of these things happening around the psychological level. You don't want to be more, comfortable here. You want to just take your profits and then just leave the market. Now let's go to the practical. How do you plot your psychological levels? I have taught you how to, get your imbalance manually. Let me also teach you how to get your imbalance automatically. There is an indicator called imbalance detector by Lux Algo. If I just activate this imbalance detector on TradingView, it is going to pretty much draw out all the imbalance for me automatically. The sell side imbalance and the buy side imbalance is going to show it out for me automatically in whatever time frame. And you can see that even that place that we actually drew, you can see that the software picked it for us. Look at the place we drew. The software actually also detected that there's an imbalance there. So you can use this software to check those imbalances that has not been filled, right? And place an eye on it, that when price goes back to those levels, fills those imbalances, and you see something like a reversal or a reaction, or pretty much anything that shows that price is respecting that level, right? Then you have a trade. So now I'm going to show you practical how to draw a psychological level. Now this is gold, for example, right? And you can see currently the price of gold is around 3,300 and $76 per ounce of gold. So you can say, okay, psychological level 3,100, 3,200, 3,300, 3,400, 3,500. How do you draw that? Just come to one of your lines right here, horizontal line, place it here. Okay, just do alternate H as much as you can. We have another alternate H here. So we have all of these lines that are in place. So now you can begin to plot these lines, right? To capture what? The psychological levels of gold. I'm just going to plot, like, maybe we'll just have just 2 minutes more. I'm just going to plot like maybe 3 pairs, how to plot it. So we have this level right here, 3,000. This, I can just make this 3,400. So I come to the settings of the line and I change the coordinates to 3,400. Done. I've plotted that psychological level. The next psychological level is 3,300. Done. The next psychological level is what? 3,200. Done. So let me just leave it at this 3. So what do you see? What do you see in the market? When you draw your charts like this, it becomes way more easier, because you know that the market is moving from one psychological level to another psychological level. Can you see the movement? Market moved from this psychological level. It came to this psychological level. It, danced around the psychological level a little bit. We're expecting something like a reversal. It didn't happen. And then what happened? Price kept on going up, kept on clearing all of those imbalances. You can see an imbalance here that the Lux Algo indicated right here. If you spot out this imbalance, what happened? Price actually respected that imbalance right there. And then what happened? Price filled up that gap. And then what happened? It went down to a psychological level. Is it a coincidence? You tell me. Is it a coincidence that when price got back to this psychological level, it started buying back up? It's not a coincidence. That's to tell you that these psychological levels are very, very powerful. And if you understand how to use them, you cannot be on the wrong side of the trade. You can see now, price has come back now to this psychological level, right? It's crashing to the downside. Where do you think price is headed if price continues to go to the downside? Of course, price will be coming down to the psychological level. So by the time you have your entry modules in place to say, okay, now I have the direction of the market, I put my entry conditions in place. Okay, entry 1 condition met, entry 2 condition met, entry 3 condition met, I'm engaging. When you take a trade, where do you want to take your profits? Of course, at the psychological levels. Of course, at the psychological levels, you can see the consistency. We are almost out of time. I don't want to just keep drawing psychological level, but on your own spare time, I want you to take out time and draw out these psychological levels. You are going to see the consistency. It is going to make your trading a lot more simpler. You can see now, this is 3,400. It will shock you to know that even this point that price got to and started dropping is a psychological level. Let us plot it. If that is 3,400, the next level will be what? 3,500. So let's put 3,500. Can you see that now? Look at where the price is. 3,500. Is it a coincidence that price just went to 3,500? In fact, gold has never hit 3,500 before. Never. It happened for the first time this year. Is it a coincidence? It's not like price went and hit a particular level, a support level. There is no support here. There is no resistance here. This is an all-time high, a new level that has been created. So is it a coincidence that price went to 3,500 level and then begin to crash down? It's not a coincidence. It's a psychological level. So if you understand how the psychological levels work, I can tell you your charts will be much more simpler. You will be in a trade for a very long period of time. You will not be in and out of trade. You will just get the big move, right? Keep it simple. Just get the big move, ride the trend down to under psychological level, and you make the money. Let's look at another pair, just one pair. I'm going to teach you how to do the psychological level for this pair. Let's look at, let's say, USD JPY, for example, right? You can see the USD JPY, moving pretty nice and easy, okay? So a good psychological level for this would be we have 150, we have 140, just like that. You can decide to put all those psychological levels in between because the pip count for USD JPY is quite different from the pip count for USD CAD. So you can plot your psychological levels to say, okay, let me do 14900, put the level right here, just change the last 3 digits to 0 right here, and then you can put, this is 146, let's just put 14600, 14600 right here. Okay, 14500. Let's do 14600. $146. Let's put the last one, 147. Now, I just decided to keep it at 148. Guys, is it a coincidence that price went to 14800 and started crashing down? Is it a coincidence, guys? No, you talk to me. Is it a coincidence that price just went to 14800 and started crashing down? Guys, psychological levels are powerful. If I see this on a 4-hour time frame and I see this huge rejection, look at the body to wick ratio of this candlestick. Look at the body to wick ratio. You can see that huge rejection around that psychological level, and then you can see that price actually, close bullish. Look at the candlestick that followed it. Institutional candlestick. Psychological levels will make your trading much more simpler, guys. Now, currently, price is currently what? At another psychological level. Look at price crashed down from 14800. Price has actually tapped into 14600, right? And we are seeing what? Something like a rejection to the downside. If we can have a bullish close, like a bullish close, and I see that the bullish close, the body to wick ratio, I see the rejection, I see the body that this is a very, very good decisive candlestick, that would be my change of structure. That would be, I'll be looking forward for what? Buy trades, guys. I'll be looking forward for buy trades, at least to cover up this what? Imbalance. To cover up this imbalance, I can say, okay, my TP1 should be that the imbalance must have been covered, and then my TP2 should now be my psychological levels. So that is how to plot it. Simple. Make the last 3 digits 0. Simple. Just look for whole numbers. I can go on and on. This will be the last one I'm going to plot for you. The last one I'm going to plot for you. Just to show you that psychological levels are powerful. I'm not talking about going in with a pending order. I'm just saying allow the thing to play out. Allow it to play out first. Once it plays out, you can now go in with your trade. So we have another psychological level somewhere here. Now you can see that price nearly tapped into that psychological levels. Now, this can be as a result of a difference in price feed, because some brokers, by the time you compare brokers, maybe you check from some other price feeds, some other price feeds can actually show that price actually tapped into the psychological level. But for me, that sees that price nearly gets into the psychological level, I can also, as much as just assume that it actually tapped into the psychological level, because if not that it tapped into the, why are we having this much of reaction in the market? Then we have this 1.3800. Let me just draw like 3 more. 3,700. Okay, let me draw just one more again. 3,600. Let's do 3,600. 3,600. Good. So if we zoom it out, just these three that I've drawn, if you zoom it out, you see the consistency. You see the consistency. Price came to the psychological level. What happened? Look at the reaction. This reaction you are seeing, it is going to fill those imbalances. Those imbalances we talked about. It is going to clear those imbalances. Now it has done clearing the imbalance. What happened? Price begins to fall back down. Where? To that same psychological level. And then you see price reacted from a psychological level again. It couldn't clear all of those imbalances. It just kept on going to the downside. So psychological levels, my friends, would make your trading a lot more simpler. I know to make you become a profitable trader, you need different concepts. You need to be aware of what is possible in the market, which is why this lecture is for 5 days, 5 solid days. So you have gotten just one part of your trading success, one part of your trading success. You don't want to miss on Tuesday. You don't want to miss on Wednesday. You don't want to miss on Thursday. You don't want to miss on Friday. This is just one part of the entire puzzle. Okay? And you can see how powerful this one part is. Imagine what will happen when Mr. Michael handles his session. Imagine what will happen when Dole handles his session. Imagine what will happen when our coach Tony George, handles his session. So you don't want to miss it. This is the power of psychological level. You have seen the consistency. You have seen what the imbalance is also talking about in the chart, how these imbalance levels are very, very powerful, and how you can help scale up your trading journey. Let me see how many people are here. If I've made sense, guys, type value in the comment section. I want to see value in the comment section. Ladies and gentlemen, that brings us to the end of today's lecture. It was a nice time having this chat with you, and for every one of us 68 people who have been, you are still here, 68 guys are still here. I want to say thank you so much. Everybody give us a thumbs up. Thank you so much. This class has been recorded and you will get the recording shortly. And for everybody that needs to get their account funded or anything, now will be a best time to consider investing in your trading journey.